In this video, let us learn about the risk measures for bonds. In the financial markets, risk refers to the possibility that an investment will not produce the expected return or that it may even result in a loss of capital. While fixed income securities like bonds are considered to be relatively safer instruments on account of the regular income streams they offer, these instruments are also subject to multiple risks, specifically when sold prior to maturity. Factors affecting bond prices. Bond prices fluctuate on account of multiple factors on their own or in combination with others. Some of these include supply of and demand for bonds, level of interest rates, liquidity or money supply, inflation, credit rating of the issuer, global yields, etc. Factors like liquidity and credit rating have a direct relationship with bond price, meaning any increase or decrease in the factor leads to a corresponding increase or decrease in the bond price. While factors like supply of bonds, interest rates, inflation and global yields have an inverse relationship with bond price, meaning any increase in the factor leads to a corresponding decrease in bond price and vice versa. Price and yield have an inverse relationship. Bond investors face following types of risks. Interest rate risk or market risk, which arises out of adverse movement of prices of the securities due to changes in interest rates. This will result in valuation losses as the securities are sold at lower than acquisition price. Reinvestment risk, which arises when the investor may not be able to reinvest cash flow proceeds at the same yield due to fall in future interest rates. This will reduce the realized returns. Liquidity risk, risk which arises due to inability or difficulty in selling the bond causing loss to the seller. Credit risk arises when issuer defaults on interest payment and redemption obligations. Government securities are considered as near risk-free from default as sovereigns rarely default on their payments. Technically, G-SECs can be considered to be credit risk-free. To measure bond risk, investors can use various metrics, including duration, also known as Macaulay duration, which measures the sensitivity of a bond's price to changes in interest rates. A bond with a longer duration will experience a greater price change for a given interest rate change. Expressed in terms of years, it is a measure of the time taken to recover the initial investment in present value terms, that is, the time taken for a bond to repay its own purchase price. Modified duration captures the percentage change in the value of a bond due to 1% change in interest rates. PV01 represents the absolute change in the value of a bond due to 0.01% or 1 basis point change in the yield. It measures the present value impact of 1 basis point movement in interest rate. It is often used as a price alternative to duration, which is a time measure. Higher values of modified duration and PV01 indicate higher change in the value of a bond due to any change in interest rates. In conclusion, investors can manage bond risks by holding securities till maturity to address market risk and using advanced risk management techniques such as use of derivatives, which require adequate caution.